All right, hi everybody. Welcome back to the channel, and thank you first of all for everybody who's been subscribing to the channel. We actually just hit 2,000 subscribers plus, and in case you're wondering what we're all about on this channel is all about how to generate passive income and alternative income streams from the traditional 9-to-5 corporate job, right? Nothing wrong with having a 9-to-5 corporate job, but I don't know about you, but for myself and my family long term, I want to try to generate income that is separate from a traditional 9-to-5 corporate environment. So that's kind of what I look at in terms of, how do we obtain financial independence long term? And that's what I like to talk about on this channel. And one thing that I really like to talk about are dividend ETFs. And specifically in this video, I wanted to talk about this portfolio that I kind of built. You'll see there's 10 different ETFs in this portfolio. And before you go to the comment section and talk about these ridiculous dividend yields, if you're familiar with dividend investing and how that works, you'll see here that, for example, one of them yields 107%. One of them also yields 118%. I've talked about a couple of these on the channel in previous videos. I'll leave the link in the description to check that out. But really what I wanted to do is kind of get into this and just go through these one by one. So there's 10 different ETFs. 2 of these actually pay on a weekly basis. The rest of them pay on a monthly basis. So what you're doing is you're investing, let's say $500, $1,000 into each of these, and you're getting back a specific dollar amount in terms of the dividends paid either on a monthly or weekly basis. So 8 out of 10 of these are going to be monthly. The other one is going to be, or the other 2, as you'll see, not available. They're new ETFs, so I put not available, but we can calculate those yields as we go through these. The point is, there's 10 ETFs total. Most of them pay on a monthly basis, which means if you invest, let's say $1,000, if you have a yield of, let's say 10%, like this first one here, you'll get back $100 a year, essentially. So that's an annualized dividend yield that you would essentially get back from these ETFs. Now, always keep in mind that you're going to have your own risk tolerance, your own investing goals, your own whatever it is you're looking for is the point. So as I go through these ETFs, just remember that these ETFs do come with different risk. One of them, as you'll see, Coney, for example, year to date is down 35%. So that's a substantial risk, right? And we always want to factor that in to our analysis as we talk about these. But what I love about these ETFs is that they all pay those dividends consistently. And one thing I like to think about with these is, like, if you think about a rental property, you're getting paid on a monthly basis, right? Kind of similar to this. You're going to have cap rates when it comes to rental properties. You're going to have, all those different metrics you look at. But in this case, we're just looking at dividend yields and, how much are we getting back, along with, what's our principal look like, and how much principal are we either growing, or, are we growing our principal? Is our principal going down? Or, what's our investment look like? And in this case, the first one we can talk about is GPIQ. As you'll see, 10.73% on the yield there. And this was just taken on Friday, so this is all accurate information. As you'll see, they're paying an annual dividend of $4.91. The ETF itself trades at $44.35 right now. And so we have a dividend that is paid out every single month. And this is the Goldman Sachs NASDAQ 100 Core Premium Income ETF. So this one in particular is going to be one of those payers that is quite consistent. And that's what I love about all these. They're all paying those dividends constantly. Since November, this one was trading at 39. You'll see a slight uptrend in the ETF, but this is relatively new, actually. And so keep that in mind as well as we go through these ETFs. This one in particular has only been around since November of 2023, so not even a year at this point. But as you'll see, since it's come out, every single month they've had those dividends. December, they had two dividends, it looks like, in December, probably to make up for what they planned to pay out in January. And then February, March, April, May, June, and July. And one thing I like about this ETF, if you look at the dividend history so far, it's pretty consistent. To be honest, like, the amount of dividends you're getting from this ETF are anywhere from 37 to 40 cents per share. you're getting a more consistent cash flow. Some of these ETFs can be all over the place in terms of how much in dividends they're paying out. But in this case, you're getting roughly a 10% dividend yield, and you're getting, every single month deposited into your brokerage account. And as you'll see here, since inception, this ETF from $38 up to $44. You'll notice that it says Goldman Sachs NASDAQ 100 Core Premium Income ETF. I do encourage you to look at the prospectus for this ETF. It'll give you a lot of information, and all of these ETFs for that matter. But if you can go to the website as well. You can go to Goldman Sachs website. They will have a specific page on it. If you type in, prospectus, for example, GPIQ, you'll see that you go to Goldman Sachs' website, and for all of these ETFs, it'll be the same thing. It's required by law to have this information. But basically what you'll do is you'll look at all the stats on this. You'll look at everything that they're investing in, how they're managing the portfolio, what are they investing in, which companies. You'll see some common names there like Tesla, Microsoft, Apple, etc. So as we move through these, just remember that. But that's it for the first one. Let's get into the second one here, SVOL. This one is from one of the people I've been working with, Izzy. I've been doing consulting work on the side, so check out that link in the description if you are interested. I do offer consulting services. I also offer services for the series exams like Series 7, Series 63, Series 65. I can tutor you on that. I actually used to hold those licenses, specifically the 63 and the 7. So I did work in the financial services industry for a while. And so I do have experience with that if you are interested. But moving on, SVOL, this one came from my my friend, partner, Izzy. Thank you for this recommendation. We've been talking about this one, and he brought up a good point, I think, with some of these ETFs, and that is like always watch for the volatility, right? Always watch for, and this is something we talked about, is like, as you'll see here, this one, it's come down a little bit. It's from 23 all the way down to 21. You'll see kind of it's in this downtrend almost. You see this large candlestick where it went down from, 22 almost down to $21.32. But if you look at the dividend yield itself, this has been out since, it looks like near the end of 2023. And a 16.92% dividend yield according to FinViz. If we go over to, we just go to Google and type in SVOL ETF, you'll see here that it was down 3.40%. Now on Friday, as of making this video, the market was down. I think the NASDAQ was down like 2%. But always keep in mind, and actually I take that back, guys. I do apologize. This ETF has been around since 2021. This chart actually only goes back to 2023. So that's why you're only seeing. But this ETF itself is actually going back to 2021. I believe the other one we talked about, GPIQ, real quick, just to confirm with you, I didn't make a mistake on that one. This one has been around since 2023, so that is accurate, as I mentioned, since October of 2023. But the other one we're talking about here, SVOL, as you'll see it yields 16.31% according to, I think that was NASDAQ.com, where I got that information from. So as you'll see here, it's down 3.40%. And as of all time, it's down 17% since inception. So keep that in mind, guys. With these higher yield funds, one of the risks you're going to run into is that you're going to have the potential to lose your principal over the long term. We've seen that with other ETFs like QYLD, for example. This one down almost 2%. $22 all the way down to $16 over the last 5 years, down 25%. This ETF has actually been around since 2013, believe it or not, starting at $25. But this also has paid out consistent monthly dividends of 10 to 12%. So it really depends on if you're reinvesting, if you're dollar cost averaging, and all that kind of stuff, which I talk about on the channel. But right now we have a 16.31% dividend yield. You'll see I have different weightings on here. My favorites have to be JEPQ and JEPI. We'll get into that as well. But for SVOL, you'll see 16.31%. You have the 1 year performance and the year-to-date performance as well. Currently down 5.79, 6.57%. In terms of the actual dividends, if we're looking at SVOL, you'll see here that the dividends themselves, if we go to NASDAQ.com, which is my favorite website for checking this information, this yield is slightly different, but we do have consistent payouts. Another thing I like about this is the fact that you're having those consistent dividends, like 30 cents paid out every single month. You're getting those into your account. It's not a month that they've missed, right? And there's very, very consistent dividends, pretty reliable in terms of, for the most part, you're getting 30 cents roughly. They did, it looks like, have a slight cut in terms of the dividend back in 2023. But I mean, nonetheless, like, these dividends are very consistent, so that's what I like about it. Moving on, though, to NVDY. This yield is the highest on the list at 118%. I have, in fact, talked about this ETF. I believe NVIDIA stock was actually down on Friday. So this one is tied to NVIDIA stock. And as you'll see, it was down 1.78% on Friday. If we look up the ETF itself, NVDY, the ticker, you will see that it was also down 1.68%. So not quite as much as NVIDIA, but quite close, right? So it was down 1.78 versus 1.68%. This is kind of what you can expect as well. So as NVIDIA sells off, right? We know NVIDIA's gone parabolic at this point. Things have gone quite well for NVIDIA, but as it faces a retracement, you can see how the ETF goes down. Over the last month alone, this ETF is down 19%. So although you're getting over 100% dividend yield, which is absolutely insane, that means for every, let's say, $1,000 you invest, you'd get $1,000 back per year at 100% dividend yield. You're getting back your initial investment every year in dividends. On a monthly basis, it comes up to roughly 8 or 10%, or 8 or 9% actually is more accurate. But the fact is, you're getting a very substantial yield on this ETF, but at the risk of your principal, because the higher the yields you have, the higher risk there is that the ETF itself underperforms significantly, and that's simply due to the fact that you can't really have your cake and eat it too, right? So that's the entire thing with this, is that you can get these super high dividend yields with an ETF like this, but if NVIDIA goes down by 50%, you can expect this ETF to fall quite substantially as well. The caveat to that, or the main benefit, I should say, with this ETF, once again, is the super high yield you're getting. But if you're losing your principal, it really depends, once again, if you're dollar cost averaging, are you buying more as the price goes down? Long term, what are your goals? Are you reinvesting the dividends? Are you taking them out in retirement? This dividend is less, actually, it's not quite as accurate on finviz.com. It is, in fact, over 100%. If we look at, for example, the NVDY, you'll see here that it was, so NASDAQ says about 120%. But this one is relatively new, so it's only been out since February of 2024. And so as you'll see here, they've paid every single month over $2 per share in dividends. So $2, $1.53 was the initial payment they had, but you're getting substantial dividends with these. Just keep in mind that as NVIDIA price sells off, you're probably going to see this one sell off as well, even if it's not as much as NVIDIA stock. But you do have that substantial risk with the net asset value erosion, to where this ETF could sell off quite dramatically, just due to the fact that it's paying such a high dividend yield. And like I said, you really can't have your cake and eat it too. You have to trade one for the other. Now, we also have XDTE. This is a new one. Izzy, I think you pointed this one out as well to me. This one's interesting. So XDTE actually pays on a weekly basis. If we look at these dividends here, every single week you're getting paid. And this one is so new, in fact, it's only been out since June of 2024. And as you can see, it's already been paying dividends on a weekly basis. 628, 75. The most recent dividend was actually yesterday, so it pays every single Friday. And you're getting right now, so the price of this ETF is $50 a share. If we assume, even on the low end, the lowest dividend this has paid so far is 20 cents, and they're paying on a weekly basis, right? So take that times 52. That's over $10 in dividends. And the ETF itself is trading at $50 per share. So we will just take that divided by 50, make it easy. And you're looking at a yield of over 20% on this ETF. So quite substantial. I mean, anything north of 10% is going to be quite good, let's be honest. I mean, a 10% dividend yield. The Fed funds rate is 5% right now. So you're looking at a pretty good yield, and you're getting dividends on a weekly basis. It's actually very similar for the next ETF we're talking about, which is QDTE. This ETF, if we look at the same thing here, you will see that the ex-dividend date and everything, every week they're paying out. So they paid a dividend yesterday, which was Friday. Basically every single Friday, they're paying out these dividends. So this one came out pretty much at the exact same time. If we take the lowest dividend and then we take the price of this ETF, so worst case, let's say 19 times 52 on a weekly basis, over $10 in dividends once again. 41.50 is the current price. We will divide that by 41.50, and as you can see, you're looking at almost a 25% dividend yield for this ETF. So these two weekly, the rest of these are monthly ETFs. All of the rest of these we're going to talk about, but quite substantial yields. And I put not available only because the yields, these ETFs are so new. They're not even really being calculated yet by the website. So I put yield not available, but you can calculate it yourself by kind of averaging out the dividends or taking the lowest or the highest or what's expected in terms of those dividends, right? So you can kind of factor that in based upon what they've paid so far. But both these pay every single week. So every Friday you're going to get those dividends into your account. They've been out for such a short time. It's really hard to gauge performance at this point as well. Another risk you're going to be taking, so like for example XDTE, if you look at the chart, I mean you can kind of see the short-term chart since it's only been out since June of 2024. But I mean, as you'll see, they've had all these dividends paid out on a weekly basis, right? So pretty much dividend April. I mean, it looks like it's actually been out since March. So I don't know why FinViz is not calculating these dividends, because if you look at the actual chart for this, I stand corrected. So XDTE, if we look at the long-term chart on this, we have a dividend going back to March, right? So actually, NASDAQ.com has just not been calculating the dividends. So actually, it's been around since March, not June. I do stand corrected on that. And but as you'll see, I mean, the ETF is already testing these lows down to $50. So with these high yields, what will happen? It's too early to tell. But just remember, typically with higher yields, you are sacrificing the capital appreciation potential. So if you have a lower dividend yield of 3 to 5%, there's more of a chance that you'll get some good share price gains versus these super high dividend yield funds where your net asset value can erode and you can lose the principal that you've invested at the expense of super high yields, right? So choose your poison. What are you looking for? What's your risk tolerance, etc. Same thing though with QDTE real quick. If you look at QDTE, type that in. So this one came out in March once again. So 13.38% it says on FinViz for the yield on this one. But I think it's too early to tell. It hasn't even been a year yet this ETF's been out. You can kind of average those out, but still it's kind of, and as you can see, it started off at pretty much almost $47 a share, and now it's down to 42. So these, unfortunately, with these covered call funds and everything, it's just, like I said, you're sacrificing that share price growth for income. But, it's fun to talk about these ETFs and to kind of get a feel for what you might be looking for. If you're looking for these or you're looking for something else, like I said, always consider your risk tolerance and investing goals and what you're trying to achieve. But let's move on here to Bally, or Bally, B-A-L-Y. This one is the BlackRock Advantage Large Cap Income ETF. Now this one, since inception of October 2023, starting off at $25 and now we're at $28.64. So a positive share price growth rate, but the yield on this one's only 6%, right? So 6% you could argue is still decent, but what are you looking for, right? Bally, B-A-L-Y on this one. Type that in. And we have a yield, as you'll see, down 1.48% today because the market was down. But since inception, since this came out in September of 2023, starting off at 25, as you can see, now it's 28.64. Looking at the history of this fund, you can see that we have in fact paid out a yield of almost 8%. The annual dividend is over $2.20 per share. You'll see those consistent dividends coming in every single month. The last payment was 8.6. The one before that was 7.5, 6.7, etc. And so every single month they've been paying out. Personally, I prefer funds like this where you have the potential for a decent yield of, let's say, 6-7% even up to 10, 11%, and you still have the potential for share price growth. When you start getting into the 20, 30, even 50, 100% yields like these right here, 107%, 80%, in my opinion, it's a bit excessive. You're probably going to see massive NAV erosion, and you're probably going to lose your shirt on the principal. That's one of the things. Now, as we discuss the rest of these, keep in mind, like JEPQ and JEPI I've talked about. We'll go through those real quick. But these last three right here, or these last two, I should say, I personally would only use these to juice the current yields that I'm getting from other ETFs, which means I'm only going to put 5%, right? I'm going to put most of my portfolio in things I feel comfortable with. Bali, I think I'd even probably increase the allocation to that. This one I'd probably lower that back down to 5%. Just looking at these weightings, even this one probably 5%. Probably allocate more to Bali, JEPQ, JEPI. I mean, Bali has not been around for that long, but at the same time, I mean, we have a positive share price growth rate already, which is a good sign, especially in a bull market. You want to see that kind of stuff. So with that being said, let's move on to JEPQ, JEPI, the JP Morgan NASDAQ Equity Premium Income ETFs. I've talked about these a lot on the channel. These are some of my favorite ones. It was down 2% as the market closed red on Friday. But as you'll see here, starting off at $49 all the way up to $50. So the net asset value has remained intact since 2022 when this came out. It's not really going to benefit tremendously from the share price gains of the NASDAQ. But nonetheless, you have a positive share price growth rate. JEPI, same thing. You have some potential for share price appreciation along with those dividends. And as you'll see here, if you go down to JEPI stock dividend, this one yields about 6%. Looking at let me go back to the chart for JEPI because I forgot to talk about that. JEPI dividend. JEPI chart. Or JEPI ETF. So here we go. Over the last 5 years since inception, up 12% on the last 5 years since 2020, this ETF came out. So we've had some share price growth. As you can see, it has underperformed significantly since then. So another consideration. And this is why a lot of people don't like these ETFs, just because, you have the potential for share price growth, but it's really at the expense, even with these yields of 6, 10, 11, 12%, whatever it is, you're not really getting a good amount of share price growth. So if you're reinvesting the dividends, that's one thing. If you're continually building a position to where you can get more and more income, that's one thing. But if you're not doing that, then you can really underperform, especially if you're withdrawing the dividends, right? Which is what we want. Eventually we want to take these out for retirement, live off the dividends, not have to work anymore. I get it, right? But at the same time, it's like you're sacrificing your capital growth for monthly dividends that are quite large, but you are taking a sacrifice, right? So, but at least it's positive. That's the thing too, is like at least it's positive since it's come out in 2020. We have a positive share price growth rate. We have not gone negative on our share price growth. So that's a good sign. Now, Coney, you'll see this one has underperformed significantly. This is just due to the fact that the yield is so massive on this. I mean, down 2.57% today. In the last 5 days, down 15%. Once again, you cannot have your cake and eat it too. $20 down to $17 within 5 days. That is significant. Over the last month, we are down 18%. Last 6 months, down only 11%, but still. Year to date, down 35%. In the last year, down 13%. So this ETF came out in August of 2023. It's just one of those deals where it's tough. It really is tough. Choose your poison. The yield is tempting, but that share price craziness where you spiked up $30 very briefly, but you can see this volatility, and then we just keep on going down. It looks like it's hitting these lows, and it would not surprise me to see this keep going down with that massive dividend yield. If you look at, for example, NASDAQ, you'll see they pay on a monthly basis, but you're getting basically over $1 per share per month, comes up to 110% yield. Pretty crazy, right? So moving on to the next one, TSLY. This is based on Tesla. So as you can see here, Tesla stock down 4% today alone, down 20% over the last year. You know, this ETF in particular, TSLY, the ETF, is not going to be doing very well, right? Down 4.45%, 18.91% in the last month. Yeah, you're getting a huge dividend yield, but at what cost, right? So year to date down 40%, 1 year chart down 56%. That's why if you are going to invest in these things, guys, I would recommend being highly diversified. You don't want to put all your eggs in one basket. I saw somebody say that they had over 16,000 in dividends from these ETFs, these yield max, super high yield ETFs. Like I said, they can be used to juice yields because you can gain substantial dividend yields, as you can see according to NASDAQ.com. Massive, right? But at the same time, it's just, is it really worth losing 50% of your principal on paper, right? Even if you're getting a massive yield. Maybe it is. Maybe you're reinvesting the dividends and dollar cost averaging in a Roth IRA, tax-free. Fair enough. Maybe you're making it work. Maybe you're building a huge income stream over the long term just because you're doing that. Fair enough. But like for myself, I do not want to put a huge amount of my portfolio into these super high yield ETFs. Maybe I'll put, I think the weightings on there were like 5%. Most of them were in ETFs I feel more comfortable with, like JEPQ, JEPI, etc. But 5% for these, maybe even 2.5%, right? I mean, that's how less confident I feel about these ETFs versus like these two, for example, JEPQ and JEPI. But yeah, that's TSLY. So you got a nice 80% dividend yield on that one. Like I said, the highest one on the list here is going to be NVDY at 118%. Then you have Coney, as we just talked about, at 107%. TSLY at an 80% yield. And finally, we have QILD. I mentioned that one. That's the oldest covered call ETF on this list here, our monthly dividend ETF on this list. This one does yield over 12% currently, so nice yield there. And this one actually, for how long this ETF has been out, I will say it's held up quite well. I mean, this one has been around since, we can go back. If we look at over the last 5 years, or since 2019, it's down 25%, but you've really made up for it with that yield. And so choose your poison once again. I mean, you have 32% down all time, but you're getting that nice yield, right? So your principal's going down, do what you want to do with it. This was one of the first ones that came out. I remember when this came out, I think people were kind of surprised. Like, this was a newer edition, and going back to 2013, over 10 years ago now, at $25 was the original net asset value, down to $17 roughly currently. And you can see it's just in a consistent downtrend. But I will say, for how long this ETF has been around, it has held up quite well. Yeah, that's the last one on the list here. Let me know what you guys think in the comments down below about these ETFs. I think, like I said, there is potential. You could invest in all of these ETFs and get a pretty good yield overall. If you average these out, if you average these yields out right here, you might be looking at 15, 20% with these weightings. You might be looking at investing $100,000 and getting back $10,000 or $20,000 in income, or more, depending on how you weight these things. But once again, what's your principal look like on these investments? How are you actually managing this to the point where you are not losing your shirt on the principal and losing all of you've invested? Because is it really worth losing everything you've invested? Is it worth losing your principal for the sake of yield? Right, that is a big trade-off that people have to ask themselves. I was quite shocked, to be honest, when I saw this one, NVDY at 118%. First time I've seen something like that. Coney as well, TSLY. Like I said, I would prefer, I'm going to diversify my portfolio if I'm going to do this, but I'm also going to focus more on the reasonable, more conservative funds that have been established, like JET, even QILD. It's held up okay over the last 10 years for how long it's been around. I might throw some into Bali, or Bali, however you don't want to pronounce it. I might put 50% into those 4 ETFs. Then I might put 2.5% into these higher risk, in terms of my principal, right? Higher yielding, higher risk funds. And so I want to keep a smaller allocation to those, while putting a higher allocation into the funds where I know my principal is going to be safer, right? So I'm not sacrificing my principal for a